Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami. He's going to walk us through the weekly data to see what's actually happening as we're heading into the spring housing market. Before we dive in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. Very interesting weekend with the tracker data. And I think a lot of people are confused because, again, a lot of people put way too much weight on that last existing home sales report, which many months ago we said
would be
when you have the slow thing of Christmas and New Year's. And then on top of that, you're going to have to deal with some of the snow impact. But what happened is the inventory growth is not much this year. The price cut percentages are now down almost 1%. Places like Florida, like Jacksonville, there's almost double-digit year-over-year declines in inventory. So there's a lot of confusing things, but my job here today is just to kind of make it understandable and simple, and not to put so much weight onto one report or one data line, especially when you have holiday and snow variables into place, and just take the trend. And the trend is now, we are now almost 8 months of a certain trend, and we just kind of want to go with that until that trend kind of goes away. So today is just about clarifying a lot of things.
I think it's interesting because the headline on the tracker was kind of like the stability, right? And really this whole year has been like mortgage rates have stabilized. We have these positive things happening in the housing market. And then I think the data just got funny, which we knew it would because of the snowstorm, because of the holidays. And just to see people take that and run with it and not understand, I was like, but we've been talking about this, because really it's the same story.
I'm really glad that people are starting to focus on weekly data, but also weekly data, as we write in the tracker, can be, hit to the up or downside on very short-term fluctuations. So, of course, the last 2 weeks of the year and the first week of January, I mean, we didn't even write the tracker because even before that reports came out, I said this thing is going to tank, because just kind of keep things simple. When did the housing market shift, Sarah?
It shifted starting in mid-June.
Mid-June. Okay. So what happened in mid-June is that the growth rate of inventory started to slow down. The new listings data peaked already. And then all of a sudden, the 10-year yield is about to break under 6.64. So what occurred was the forward-looking data, pending sales, purchase application, all this stuff started to get a little bit more positive. And then existing home sales went from a low in June to a 9-month high. That 9-month high is a trend about 6 months. Then here comes the holidays. Here comes winter. So we said, got to be careful of this. And what happened was the growth rate of inventory is really slowed. And last week, it's now down to 8.24%. There's parts of the country that is now down year over year already. And just always remember, take the Florida data with not a grain of salt, but in context to where it was last year. So when we see inventory down and parts of the demand curve is positive, double digits, just very, very low bar to show improvements. But this last week, the price cut percentage is now down almost 1%. So I thought what happened was everybody put too much weight on that existing home sales report and not this trend from mid-June all the way to mid-February. And part of this is when January happened, right? You always get that rebound effect from the holidays. Purchase application data positive, multi-year high. Weekly pending sales, multi-year high. Total pending sales, and then all of a sudden, here comes a snowstorm, right? So that snowstorms, of course, it's a huge snowstorm. That thing works itself out. But you can see it that the places where there was a lot of snow, activity really fell compared to the places that were sunny. Should it be shocking? The jobless claims did this. And that's the thing with weekly data, is you got to be a little bit mindful. But on a week-to-week basis, we saw a little bit bigger recovery in demand that I thought would be the case, but just because the previous week wasn't as weak as I thought it would be. But here we are, just continuing the trend. That's it. And oddly enough, the December existing home sales report, that headline number is actually higher than my total forecast for 2026. That's how high that number was. that slope really picked up toward the end of the year, and then the holidays and snow, and then you just kind of go with it. But the lack of inventory growth and the decline year over year in price cut percentages is confusing people because they naturally thought home sales crashed, right? It had nothing to do with holidays or winter and everything. And they, assumed that, price cut percentages would be accelerating, inventory would be growing. It's just, it's not that year so far. So now we're in mid-February. Now you start to get into the seasonal increases in inventory. And just remember, the comps are going to be very, very difficult this year because last year was really good. We're not going to obviously get that same kind of growth. So if we have some negative week-to-week data on the inventory side, take that in context. So I'm trying to clarify this stuff because a lot of people are confused that why is the price cut percentage falling? Why is inventory not rising? Home sales just crashed. And it's just trend, right? Aggregate data trend is more important than kind of one thing, one report, especially when you have different variables impacting. And this is why last year we focused on the tracker, be careful of weeks where there's a holiday, be careful of Christmas and New Year's, be careful of one of the biggest snowstorms in history. So you're going to have to wait it out and just go with the data and how it flows out. And hopefully that makes sense because I could just see the confusion by some people, why isn't inventory not skyrocketing? Why is price cut percentages not rising? What's going on here? And just take it from mid-June to mid-February, take the holidays out of the equation, take the snow out of the equation. It's a basic trend out here, and we just kind of go with it.
So you mentioned the price cut percentage, and that's what stood out to me on this tracker because last summer, I think the price cut percentage normal is about 33%. It got as high as 40% that homes were taking a price cut before they could sell. Some people ran with that and they were like, oh my gosh, this is, the start of the crash. Really what it was is just always people have to adjust their expectations on the seller side. But to now see it go down a whole point, and now we're at pretty low. I mean, we're lower than normal.
Well, I would say 1/3 is we're normal right now, and we're elevated from, let's say, the points of COVID where it was really unhealthy. So it's kind of like a normal year, and I think that's not what some people were anticipating. So again, I urge people, you have to be careful of who you listen to, right? We just had a debate with a New World Order guy, right? And it was just man, homie was talking about shipping lanes and mortgage rates going from 6.5% to 5.5% to have the biggest home price crash in the history of America, nominal in 1 year. That's not economics. That's doom porn. That's attention. That's engagement. That's not what people should be listening to. You follow the data. Why? Numbers are the closest thing to the handwriting of God for a reason, because if you take the human element, you put the human element into it, then you can become just the most craziest things ever on either side of the tail. So just follow the data and run with it. And so far, it's kind of the same thing. Demand just picks up a little bit. The growth rate of inventory is cooled down. It's still up year over year, but you can see the slope of the curve. Sarah,
you love this.
We always say we love our data because it's the slope of the curve. And that slope of the curve looks different because the weekly pending sales before the snowstorm was positive. The growth rate of inventory had already slowed down. And we're just trying to visually get people to understand what is going on. So they're not surprised that the price cut percentage is now down year over year, because when rates get down near 6%, things change in the data line. And a lot of that is because when you're working from such a low level of demand. And when I talk about the lowest levels of sales ever, I'm adjusting it to the workforce, to the household. So it doesn't take much to move the needle. How many times have I said that for the last 3 years? It doesn't take much to move the needle, but the supply and demand equilibrium needs an entire slope of the curve data lines where inventory, new listings data, price cut, weekly pending sales, total pending sales, purchase apps, 10-year yield spreads. That's why the tracker was created, to get everybody on page so things won't be so confusing as it is, because there is a lot of people are just, what is going on? So hopefully that makes sense of the weekend tracker report.
It does. Okay, so let's talk about mortgage rates. Interesting morning. So we are recording this on Tuesday morning. and what's happening. We weren't sure what was going to happen with the bond market coming into this morning. Walk us through that.
Well, again, for those who are part of the Instagram family, Nerd Nation 24/7, we are in a what I call a bull formation on the 10-year yield. We got up to the upper levels, and then all of a sudden, that uptrend that we were creating on the 10-year yield, it hit that key level, and then all the bond traders just went for it. I would tell you this: people that I know that are bond people who really think yields should be higher, they even flipped, right? And I kind of show this in a video. Technically speaking, there is no bond vigilantes. These guys are traders. These men and women trade to make money. If they don't make money, they don't have their lifestyle. So their ideological things don't care. And all of a sudden, technically something broke. And then all of a sudden, it was a really big drop. We almost got down to 4% again. I'm going to have to bring out that picture. A running joke for me, whenever the 10-year yield goes below 4%, I always bring that picture out. We all survived the 4% 10-year yield because people freak out when the 10-year yield got to 4% a few years ago. In any case, we're at the low level of the range here. And there's a lot of talk on the market side that this is really the AI disinflation is happening. Unemployment rates are going to go to 15%. There's no way bond yields should go up higher. It's really interesting. There's a deflation camp, and then there's the inflation camp. And a lot of these people are actually kind of on the same team, and they just can't, they always have to take it to the extremes on both. So money just went into the bond market. Technical levels broke. We got down here. Again, we've not been able to break under 3.95 or really 4% anytime recently. So just kind of look at it as we're down toward the bottom end of the range. I have to defend my edges, right, on the bottom side and on the high side. And to me, it's just really hard for the 10-year yield to break under 380 unless the Fed gets dovish, the labor market breaks. Some of the inflation data that the Atlanta Fed and the Cleveland Fed, Beth Hammock, who used to highlight the business inflation expectation as her main thing for raising rates, that thing is pre-COVID levels. The Atlanta Fed, Bostic, who's leaving, who said, the business, inflation expectation is high. That's at pre-COVID levels. Are they going to change their theme? Absolutely not. They would probably want rate hikes, right? Because it was about the labor market. Because some of the inflation data, does it warrant, talking about maybe not cutting? It's just, again, labor data breaks. Everyone is on the same page. The data lines that they really focus on breaking just hasn't broken yet. And this is why you have these hawks that are still here, where the Christopher Waller's early 2025 was like, hey, the labor data looks soft. It's going to get revised lower and everything. And here we are with that. So interesting day with the 10-year yield. I just think technically speaking, it just hit that level and money flowed. And we're down here near 4%. Again, it's February. We're almost in March, right? And we have not had that rate spike that we're accustomed to in the past few years. And now the spreads are better. And a really good question from somebody, why are the spreads getting worse when yields go down? Just remember, the spreads duration, it's made a really, really big move from the highs of 2023. But when yields go down aggressively, the spreads do get worse, right? When yields go up, they do get better. So it manages that, supply and demand equilibrium, investors and all that stuff on both ends. But we are below 2%. Huge difference than what it was up there. And I believe the weekend tracker, we highlighted that if we had the highest levels of mortgage spreads in 2023, we're at over 7.20% with mortgage rates today, but we're near 6. So a lot of difference, right? This isn't like the COVID V-shaped recovery or anything. I'm just looking for a couple 100,000 more home sales, even below the December print that we saw of last year. And that's just working. And rates, inventory is still elevated enough that I don't have to worry about prices escalating out of control or anything like that, right? The very, very savagely unhealthy housing market of 2020 to early 2022 is over. Balance, boring. It's a good thing, right? And I just think so many people might have been thinking shock and awe or something like that's happening out there, and it just isn't the case. So again, we take it 1 week at a time, one day at a time, one economic report, but we want to show the trend, and the trend is what matters. And right now, the 10-year yield is toward the bottom of my forecast. We're only 29 basis points away from the low end of the mortgage rate forecast of this year. So if things change, which they do every single year, we go with the data, both positive and negative. But for right now, we're just here. And we have to wait till April to get the March data, which probably has most of the snow thing out of the equation, and we'll take it for spring and summer.
And that means that, the backdrop is stable so that people can go and do their business. Like they don't have to worry as much this year about like it's the volatility of the rates.
Yeah, I mean, it's never a healthy thing when rates spike up super fast or they go down super fast. For those who don't remember, on March 9th, 2020, when COVID happened, my first tweet that morning wasn't about COVID or anything. I was like, "Oh my God, we're gonna have a mortgage market meltdown." Like the early payoff risk was just crazy that week. I mean, that mortgage rates fell 1% that week and then went up 1% that same week. I mean, it was just the business can't handle volatility and hedges and stuff like that, and you get kind of margin calls and some mortgage trading, but boring, slow and steady wins the race, right? You don't need kind of wild hair or wild action. Just kind of be the tortoise and we just move with it out there. So kind of condense everything down to all this is positive, and we haven't had that reversal in yields like some people were looking for. But again, 21st century lows in job creation last year, 15,000 per month. It's probably even going to get revised lower one more time. Even this year, the job data is not breaking, but it's so narrowed down to areas. And now you have all these concerns about AI and the disinflation and software stocks selling off and everything. So it's crazy. It's a safari out there. I understand. There's a lot of crazy headlines. My job is only just to guide you through the path. Walk like Caine in Kung Fu. Walk slowly, right? And then,
oh my gosh, now that is a throwback. Okay, you got to be elder Gen X to even get that reference.
It's funny. Actually, when I was a kid, my father and I used to watch Kung Fu all the time, and then one time we always had to bring the curtains down. Those roller curtains with a metal blade. Back in the old days, and I was underneath, and he rolled it down, and the thing came and smashed my nose, and I still have a crooked, broken nose from that smashing. Getting so ready to watch Caine Kung Fu.
That's so funny. Oh my gosh, Logan, thanks for walking us through this, and we will talk again soon. Appreciate you.
Pleasure, Sarah.